This is Right on the Money with Tom Mosley, founder of Mosley Wealth Management.
Our mission at Mosley Wealth Management is to help people make sure they never run out of income the rest of their life and they pay as little as they're legally required to pay in taxes.
Since 1995, Tom Mosley and his team have been creating comprehensive, custom financial plans to help you preserve what you've earned and pursue what you've envisioned.
In retirement, a lot of people have built a great lump sum. We call that your lumber yard. But you need a blueprint to put that lumber yard into a plan that you can build a retirement house to live in.
What's on your mind this week, Southern California? The stock market, taxes, inflation, income, Social Security, how to ease into the life of your dreams? Let's discover conservative financial strategies starting right now. This is your Right on the Money Radio Hour with Tom Mosley.
And a very happy weekend to you. You are listening to Right on the Money with Tom Mosley. He is the CEO and president of Mosley Wealth Management based right here in Southern California. And I'm your host, Kristin Oakley. Each week, Tom and I are committed to providing you with retirement planning solutions. And today, the question we want to pose to all of you is, have you ever considered refinancing your finances or refinancing your retirement? Are you sitting there wondering what that even means? If you would like to know why and how you should refinance your finances or possibly refinance your retirement, you're not going to want to miss today's show. Just to set up the context for today's conversation, as consumers, we're really always looking for ways to stretch our dollar. And I think that that's especially been true in the last few years as inflation has really become a factor in all of our lives. But when interest rates decrease, our purchasing power can actually increase, which means we're able to buy more house, more car, et cetera, with the same dollar. And so typically when people hear this term refinance, I think often they think about refinancing their home or their car or maybe even student loan debts. And of course, you do want to take advantage of that when interest rates are low. But when interest rates go up, which is the environment we've been in for some time now, it could be a good time to actually refinance your finances in retirement. So, Tom, I want to start with just asking you, what does this saying, refinance your finances or retirement, actually mean?
Well, it means react to the changed environment. I think that's the best thing to say, the best way to say it.
Mm-hmm.
I mean, if we look back 3, 4, 5, 6 years ago, I was encouraging everybody who came in who still had a mortgage, if their mortgage was 4, 4.5, 5, which are, historically low rates if you go back decades and historically, but I was encouraging everybody 3, 4, 5, 6, 7 years ago to refinance their house because interest rates were low. And therefore, if you were the borrower of the money, you could get it at a very, very cheap price.
Right.
Well, what's changed and the reason that we bring up the idea of refinancing your finances or refinancing your retirement, we're not telling you to go refinance your house now, because your house, if you refinanced your home, or like some of our people who are retiring are deciding to buy a second home, you're going to pay 6% or more for a regular home. And if it's a second home, you may pay 7.5% or 8%. So, things have changed negatively on the home front. But when it comes to your retirement, now, if you want to look at the assets you have, you are a lender. You are lending your money to either the bank, to the finance company, to the insurance company, to the investment company, and they are paying more for that money now. So change can be good or it can be bad. Bad for refinancing your home, but great, or buying houses, it's bad, but great for refinancing your retirement and investing. And you have to react to the landscape that's there. And with the low interest rates and the high inflation that we've got, people are just paying more money to get access to your money so they can loan it.
It's interesting because I'm glad you made that distinction, because that is, I think, what a lot of people think about refinancing. We immediately go to our homes, our cars, things of that nature. So I'm excited for you to kind of shed more light on ways that folks can refinance their retirement or their finances. But you and I have talked off air about why this is such a time-sensitive, critical conversation to be having. So why would someone want to consider refinancing their retirement right now?
Because of what we've been told by the Federal Reserve. The villains who, if you want to see them as that, who raised interest rates 11 times to almost an all-time high, and at least in the last few decades. And those villains have now said, hey, we're going to start lowering interest rates, maybe 4, maybe 6 times this year. And then 3 weeks ago or so, back in February, they dropped a little message one day and they said, hold off, it might not be as quickly as some of you are planning. So we've already been given the indication that they're going to begin to lower the Federal Reserve rate. Now, when that happens, interest rates as to what you might have to pay on a home will go down. So maybe our kids can get back in the game for buying a home, but also interest rates for what they're paying for you to loan them your money, what they're paying you for that, those might be going down as well. What do I mean by that? I mean the bank accounts, the money markets that are 4.5% now, and annuities that are paying a guaranteed 5-year rate. I always call a fixed annuity a CD on steroids, and because they operate just exactly like a CD. You give the money to them for 5 years. They pay you a guaranteed set interest rate over a period of time. And the reason I call them a CD on steroids is usually they'll pay you 1.5%, maybe 1.25% more than you can get in the bank situation. So those things are going to probably through this next year begin coming down. So if you can imagine just my hands here in the studio going up 11 times, and they're at the very top, and now they're going to probably begin to come down maybe 4 to 6 times. Now's the time, if you're loaning your money to the bank, to the insurance company, to the investment company, to get more out of what you're doing.
For your own no-cost retirement blueprint, call Tom Mosley of Mosley Wealth Management, 888-930-5609. That's 888-930-5609.
Well, and I know a couple weeks ago, you and I were talking, and you just had your hands full with a bunch of folks who were taking advantage of the current environment to refinance their retirement. So what exactly were you able to do for some of your clients right now that can really make a big difference for them?
Well, there's several things you can do, and some, it's almost like in a situation where you need to react quickly. You usually have to do the same things that you do when you don't need to react quickly. Okay, you just need to be doing the right things. Number one, you need an overall plan. Number two, what I've seen with so many people as they approach retirement, you may be sitting out there and you may say, one guy came to us recently. From a radio call, and he had 6 401ks. Wow. And he had just never rolled them over. I mean, he cleaned out his desk. He brought his pictures. He brought everything that was on his desk, maybe even his computer, but he left his money at the old companies. Okay.
That's so common too.
It's so common. I've actually had a class recently where I was talking about people gathering all their information to come in so we can help them build a retirement blueprint. And one guy came in and said, I'm so glad I did this. I found out I have another 401k that I'd forgotten about that has $54,000 in it.
Wow.
So, consolidating, bringing it all together, putting together a plan. See, this guy had 6 401ks. One lady one time inherited from her sister 32 IRAs.
Oh, my word. That's a record. It has to be a record.
It is absolutely, by 3 times it's a record. But what this lady that passed away thought was she had to start a brand new IRA every single year. Wow. So she would go to a different company and that's great for diversification if there's large amounts of money in there. But she had 32 IRAs. So just the idea of during this time, bringing it together, because if you've got 32 IRAs, if you've got 6 401ks, you may not have 6 out there, but you may have 3. Some of those are performing well, maybe. And some of those are probably performing poorly. So this is a great time when they're offering you more money than they have in decades now to take your money and to invest and to make money off of your money and to give it back to you, at least most of it. This is a great time to put together a plan, consolidate what you've got, bring it all together and monitor what you're getting. Make sure you're not getting old rates and make sure you're not in the prehistoric age of a 1.5% inflation rate and a 2.2% mortgage rate. We're not there anymore. We might get back to that maybe someday, but we're not there anymore. Now's the time to act.
For sure. And I know we're going to continue talking more about ways to act and some things that folks need to be aware of, especially right now. How would you say investment strategies need to change given the current economic climate?
Well, the question I would come back and say what a lot of people are walking in now, they're saying, hey, we're in an election year. What's going to happen? My crystal ball, and I will go out on a limb here, but with interest rates supposedly coming down and a presidential election, I think things are maybe going to be okay for this year. Now, after this year,
all bets are off.
All bets are off. I mean, the Wall Street Journal did an article back in the late summer, early fall that the tax plans of the two different major parties, assuming we don't have a third party, there's a $6 trillion difference in what they're going to take from us and what they're going to leave with us to spend. So there's some big changes on the horizon. Banks are paying big money now. Some just money markets are paying 4.5%, 4.75%. So now's the time to react. And what do I think is going to happen with this economy? I think we're going to have a short-term bubble, really driven by the 7 big tech stocks that some are calling now the Magnificent Seven. But what happens when you take those 7 away? Things aren't quite as rosy as all-time highs in the Dow and all-time highs in the S&P unless you've got all your money on those 7. Now, if you've got your money well diversified, you're probably not making as much. And that's why you need to really look at everything closely right now. 2 things. Take advantage of this year and then be prepared next year to move again if you need. That's why you need to work with somebody who builds you a financial plan, but that financial plan is a dynamic. It's not static. It's something that you're constantly looking at. We call it a retirement blueprint. We can help you build one starting from a blank sheet of paper, scratch for you and building it for you, but you've got to call in.
Absolutely. That number to call is 888-930-5609. Again, this is for no cost, no charge, no obligation. Simply an invitation to have a conversation with Tom and the team of Mosley Wealth Management to see, could refinancing your retirement be right for you? When we come back, we're going to look at the positive impact that these increased interest rates can have on your retirement and why not making changes in this economic environment can potentially cause you problems. Stay with us.
With today's rising interest rate environment, have you considered refinancing your retirement? When interest rates go low, you might be able to refinance your homes, your car loans, and even your credit card rates because it could help you keep more of your own money each month. When interest rates go up, it may make sense to refinance your retirement. Higher interest rates could provide income opportunities that you may not be aware of. What works for your portfolio during low interest rate environments may not work for you in a high interest rate environment. So find out if a retirement refi could work better for you. Don't look down at today's higher interest rates. Find out if a retirement refi could work for you. Call Tom Mosley of Mosley Wealth Management at 888-930-5609. That's 888-930-5609. With rising interest rates, it might be time for you to refi your retirement.
Welcome back to Right on the Money with Tom Mosley. I'm your host, Kristin Oakley, and today we are talking about refinancing your retirement, refinancing your finances, and why now is the time to take a serious look to see if a refinance is right for you. And Tom, I know you shared a little bit about what we mean when we're using this term, refinance your retirement. You shared some examples of folks you've been able to walk through this process with, but I know you have a really good analogy that I'd love for you to share with our listeners that kind of sums up what we are talking about today.
Well, what we're talking about, you may be sitting out there and you may be saying, well, I'm doing pretty well right now. And I am taking advantage of some of the growth opportunities right now by them offering more money and paying more for my money. But it's 2022 when we were down 22%. That may be a great time right now to investigate taking some money off the table. I mean, you've got all of that at risk in many cases, and you've got it in the market and you've got it out there, and nothing is principal protected. We've got these gigantic boards in our office, all of our main offices, and our offices are in Glendale, Arcadia, Ontario. They're in Anaheim, they're in Scripps Ranch, and wherever you come in, you're going to sit in a conference room, and on that board, you're going to see that you've got money for the bank, you've got money for principal protected, and you've got money at risk. Money at risk is in the market. Principal protected is just exactly what it sounds like, principal protected. You may be sitting there saying, I've taken advantage of this and I've made a lot of money. It might be time for you to do like a good gambler does. Now, a good investor does, okay? Once a good gambler, good investor has made a good portion of money, maybe sometimes they get to a point where rather than being greedy, my dad used to say, fat pigs get slaughtered first. And rather than being greedy and just continuing to try to make more and more and more, maybe you need to take some of the gain that you've got and move it over into that principal protected where you're not going to lose that. You've made it. You don't want to lose it. You go back to what you were originally, or maybe just down some. Maybe you take $50,000 and you put it into something that's principal protected. Why? Because that principal protected right now is paying really good money for just that. Normally what would be lazy money. Lazy money's not so lazy anymore during this time. So maybe you need to look at moving some of the money you've made into that area. Perhaps it's time for safety. Perhaps it's time to take some money off the table. So the analogy there is like the gambler. A good gambler, they tell me, I'm not a gambler, but they tell me that when you've made money, you always pull some money over and you say, I'm going to leave the table with this. I've made some money and I might lose some more money, but I'm not going to lose this part. That's your principal protected money when it comes to a financial plan.
Yeah, so important to think through all this. And, you know, again, we started off the show explaining, I think when people hear the term refinance, they think of lower interest rates. But obviously we've been in a higher interest rate environment. And what a lot of folks don't realize is that can actually have a positive impact on your retirement. And not making changes during this high interest rate environment can potentially cause a lot of problems. So first, Tom, I'd love for you to share about some of the problems that increasing interest rates can have on one's overall financial plan.
Well, I will, but we don't necessarily have in our today, we don't necessarily have some of these being impacted yet. And the key word there is yet, because the number one thing that normally happens when you have higher interest rates, it impacts growth stock. Now, what is a growth stock? That's a company that's trying to grow. Almost, I don't know of any company that totally self-finances. Every company that's growing, a growth stock, a growth public company, is going to be wanting to borrow money. So when the interest rates go higher, that's a negative because it might impact your growth stock because the money that they're using and borrowing so that they can grow, so that they can expand. It's called leverage, so they can use it for leverage. The money that they're borrowing is costing them a whole lot more. And you say a whole lot more? Yeah, it's only 3 or 4%, maybe 2%, maybe 4%, maybe 3%. Yeah, but over a period of millions and millions of dollars, that really mounts up. So the number one thing is it could impact eventually the stock market. I believe it has, not the Magnificent Seven, you know, the Facebook and Apple and all of the Amazon and the ones that are just going crazy, right? Those ones that are just really driving the market, but those underlying stock could be impacting them already. It could also negatively impact bonds. Now, you say, where would that come in? Well, if in your portfolio you have things like a 90-10 mix and an 85-15 mix and a 70-30 mix,
The
or
60-40 we hear all the time, right?
60-40, yeah, 60-40. You know, you get close to retirement, goes 60-40. Or they might be couched under the term target funds. Now, you can Google target funds and you can Google, you know, how successful target funds have been. Well, in 2022, most target funds were down over 20%.
Yeah.
I mean, you were setting a target for 3 years until you retire, and it was down 22%. And you could be sitting there with a target of 2050 to retire, and it was down 25%, because both stocks and bonds really did not do well in 2022. Now, what happened 2023 up until now? Stocks have started doing well, but because of the high interest rates, bonds haven't. So you still are stinking in most of those target funds. Google target funds and find out, Google it in a way that you can see how successful they are. And you can see that most of them aren't doing well right now, because a 60-40 means 60% in stock, 40% in bonds. So you need to know how those things are impacting you, and you need to figure that out before you wait till the end of the year, because you've got the whole year to respond to what looks like is going to be a good year, because interest rates are going to be coming down. So you need to be making some moves and making some decisions right now.
Absolutely. So let's now talk about some of the positives and just highlight again why being in this higher interest rate environment can have a positive impact on one's retirement.
Well, right now you need to analyze, like I mentioned in the first segment, every single position you're in. And you may say, well, you know, I don't know. My broker has me in so many different positions. And a lot of times a broker will put you in so many different positions because they don't know which position is going to do well, and they don't know which position is going to do poorly, which really none of us do. But they've spread you out so that maybe they'll make gain here and maybe they'll make gain there. I've likened it to a roulette table. And I know I'm going back to a gambling illustration, but there's 36 numbers on a roulette table. And there's some people that'll play roulette and they'll put $50 on all 36 numbers, only going to win one number. So they may only win $35, but they paid $50 to play the game. So spreading it out sometimes is good, and you need to be diversified, but maybe your broker or financial advisors just got you spread out in so many different positions that you really can't get any traction and you can't gain. So you need to analyze every single position, and particularly the money. Normally we would always say this, that you're putting at risk, and that's the money that you've got in the market. That's the money that you've got there for growth. That's on our walls in our conference rooms. That's the red bucket. That's the money that's at risk. You need to analyze every single thing you've got in there to see how it's doing right now. Are you just in the big seven, or are you spread out in things that aren't doing as well? Is that invested to your risk level? And the second thing you need to do is, if you do have principal protected money, that's money that's not at risk. Your principal is protected. And that's like in a CD at the bank, or a fixed annuity, or a fixed indexed annuity. We are seeing right now people from this show and even some of our own clients coming in with fixed indexed annuities that they were put into place in a interest rate environment where they were paying 1.5, 1.7, 2.0, where even the fixed rates of some of the newer annuities are paying 3.5%, 4%, 5%, and even some of the gains that are potential in some of the new model products are astronomical. Sometimes, Kristin, they're 8%, 9%, 10% in a principal protected bucket. And that's what's so important, that you understand that out there, that you're not just trying to get into an annuity, you're trying to get into one that's going to work. Recently, my daughter got a new car. And she wanted me to drive my old car. I'm a 2002 Honda Accord. I had it when it was new. And so I went over with her to trade it and to make sure they didn't take advantage of her. And I reached down, Kristin, to push the button, and there was no button. It had to have a key. And I started to back out of the driveway, and there was no camera. I had to turn my head around and look down the street both ways before I could back out. I couldn't rely on a camera. And I got out on Alta Vista Street there in my hometown. And I tried to adjust the mirror, and there was no knob over here on my left hand to adjust the mirror on the right side of the car. She had to roll down the window and do it. Now, if you're listening to me and understanding what I'm saying, you're saying, no, cars have improved. Right. Fixed, principal, protected, CDs, money markets, fixed annuities, fixed indexed annuities that protect your principal. They're not your father's Oldsmobile anymore. They're not your father's Honda Accord anymore. They've improved dramatically, and you need an analysis to look at that to see if there might be something better out there that can help you.
That is such a great analogy, Tom. And I know that so many of you listening can relate. And here's the reality. If you're already working with another advisor and they are not having these kinds of conversations with you, it's time to get a second opinion. And that's what Tom and the team of Moseley Wealth Management would love to do for you. Again, for no cost, no charge, no obligation, they'll be able to look at your situation and see if a refinance for your retirement could in fact be in your best interest. You don't have to settle for not taking advantage of what we are experiencing right now in our economic climate. We encourage you to get yourself a solid written financial plan in your hands. That number to call is 888-930-5609. More with Tom here at Right on the Money right after this.
Get your retirement right on the money with Tom Moseley. Call 888-930-5609 for your no-cost appointment. 888-930-5609.
With volatile economic conditions, rising taxes, inflation, and interest rates, retirement has become a complex landscape. We think that today's modern retiree faces more challenges than previous generations did, such as longevity and legislation risks. That's why we believe it's important to stay informed and be prepared. At Moseley Wealth Management, we pay attention to the financial currents and develop a retirement plan that is designed to help meet your unique needs and goals. From investment strategies to tax-efficient planning, Tom Moseley and the team at Moseley Wealth Management are here to guide you along the way. Don't let today's economic winds potentially blow your retirement off course. Call Moseley Wealth Management for your own complimentary retirement blueprint and written financial plan. 888-930-5609. That's 888-930-5609.
When making important decisions in your life, how many opinions do you seek out? You might ask your spouse, perhaps family and friends, or an expert or professional in that field. Most importantly, you may seek someone who has experience with the decision you're making. A friend of mine once said, "You can't get a second opinion from the person who gave you the first one." At Moseley Wealth Management, we believe that a second opinion from a financial advisor can be incredibly valuable. Whether you're just starting to plan for retirement or you're a seasoned investor, a fresh perspective can help you identify potential opportunities and risks that you may have overlooked. Call Right on the Money and the team here at Moseley Wealth Management for your complimentary second opinion about your retirement plan. 888-930-5609. That's 888-930-5609.
Welcome back to Right on the Money with Tom Moseley. He is the CEO and president of Moseley Wealth Management based right here in Southern California, and I'm your host, Kristin Oakley. Not only are we committed to providing you with retirement solutions through both the television show and the radio show each and every week, well, we're talking today on today's show about refinancing your retirement, what that means, and what doing so could mean for you. And really what we're talking about is how to potentially make your financial plan and your financial future even better. Because Tom, after all, better is just better, right?
Better. I mean, there's no other word for it. My daughter's car. We loved that 2002 Honda Accord. You got to understand that I talked about in the previous segment. We loved that car. It had 230,000 miles on it. I drove it. My wife, it was her car for a while. My son drove it. My daughter drove it. We loved that thing. When we did take it, when I was backing out of the driveway without the camera, when we were doing that, my wife and son were sitting there looking at us, sort of waving by. They weren't waving by at my daughter and me. Right. They were waving by at that car because we were attached to it. Yes. And a lot of you, when you come into our offices, you get so attached to what you've got. Well, my mother bought that, or and if
Meaning
it's
like a
small,
certain stock or,
yeah,
a certain, right. Okay. So talk about that. Yeah.
they're just afraid to let go of something, or you've had it for a long time. Maybe it's even your broker. I had a guy recently came in and says, well, I hate to let go of my broker. I know he's doing a horrible job for me, but we go golfing about 3 times a year. Well, guess what? If he's your friend, he's still going to go golfing with you 3 times a year, but you're losing enough money to buy a golf course over a period of time.
Right.
So there are things out there when we are in an interest rate environment, an inflation environment, a stock growth environment, an election year environment. There are things you need to be doing right now to react. And to not react in a, oh my, I just lost everything, or oh my, I just lost a bunch. But hey, I need to be proactive right now and take advantage of some of the things that are out there. And don't fall in love with an investment. There are people who rode Sears all the way down from the Dow Jones through the S&P down to where now it would be a novelty item if you owned a piece of Sears stock. So what you need during this time is an overall checkup. We call it a retirement blueprint. And what we do is we analyze every single piece. We bring you in, we call that our envision appointment, where we get a vision for where you are, what you want to do, where you're going. And we start with a blank piece of paper. Oh, by the way, don't call in and ask for us to send you a retirement blueprint.
It doesn't work that way.
No. I mean, we have to know where you are. We'll send you the things that we need you to bring in for us to evaluate. And we get a vision for where you are, where you want to go. If you want another complimentary appointment, we call that the analyze step, where we analyze everything you've got. And in there, we analyze, what kind of income do you need? That's called a budget. Where's that money coming from? What does your Social Security look like? What role is it going to play? And that's changed as well, and it might change again in the future. If it does change, how are we going to adjust if Social Security only pays out 75 to 77% of what it's projected to pay out? All of those things, we analyze that. We analyze for inflation. Are you going to be growing your money for inflation and the income you need? What about your investments? How risky are your investments? What is your internal risk tolerance? We have to match those up. Here's the big one, taxes. What are those going to cost us? Here's another thing about the changing environment, the better time we're in right now. Taxes are lower in 2024 and 2025 than they will be by law come January 1st of 2026. So we go through all of that. Where's your health care coming from? Is it going to be from the company that you're going to continue? Are you going to need to go on Medicare? Do you need to have a long-term care plan, not necessarily a policy, but a plan? And then legacy. We can't do wills and trusts because we're not attorneys, but we have people who work with us to do them for our clients. So that's what we mean when we say we need to put together a retirement blueprint to put you in a better position, to analyze and make sure that every single thing on your plan, in your plan, is working. If I were going to take a trip across the country and I checked my car out completely, except I didn't look at the tires, you say, oh, wow. You need to look at everything. I mean, I need to make sure I'm not in the middle of the desert, or I'm not up on top of a mountain, or with the brakes coming down a mountain. I need to make sure that everything in that vehicle is functioning if I'm going to drive across this country. You're going to drive through retirement. You need to have it checked out and make sure that you've got the best brakes possible. You've got the best tires possible, that your starter is working, that your battery is good, that every single thing on that vehicle is working. That's what we do when we build a retirement plan. Now, we find that the people who are out there, you're in your car right now, or maybe you're listening to this at home, or wherever you're listening to this, you're sitting there thinking, I'm not sure about my fill in the blank. Well, what we do with a retirement blueprint is we go through all of that to make sure that you have not just something that's better, but as fiduciaries, we are responsible for presenting to you what is the best plan possible for you. And a lot of times we give you the options and you pick out what's best for you. And we put that plan together and we monitor it. You say, who's we? Is it just you, Tom? No, it's not just me. We have 6 qualified fiduciary advisors who work with people in all of our offices. We're in Glendale, Arcadia, Ontario, Anaheim, and San Diego in the Scripps Ranch area. And we do our best to put the best plan that's better than what you've got now into effect.
And I know, Tom, that you obviously have met with so many folks over the years. And I'm sure that for some of the people that you've met with, there actually isn't a problem with what they're doing. Maybe they already have a retirement plan. Maybe that plan is sufficient enough to get them to and through retirement. But I know that you and I both agree there's such value in getting a second opinion. So I guess my question is, if someone comes in and you look at everything and analyze everything and you see that, wow, you're on track and you're doing everything you should be doing, what does the conversation look like at that point? Do you just send them on their way? Do you often find that there are things that you can tweak or help them adjust? What does that appointment look like?
Well, that appointment looks like the old saying, if it ain't broke, don't fix it, you know? And there are people who come into us and we literally sit down with them, and after an hour, we're able to look at their stuff, and we might even do a second appointment of an analyze if they want us to just to make sure that all the underlying things like risk that they're taking and their risk tolerance and the fees that they're paying and all of those things are in line. And we'll do that analysis, but many times we shake hands at the end of that meeting and say, I don't want to move you because there's nothing I would do to change. Your person is doing a great job. Okay. But there's so many times that we've got lazy advisors, lazy brokers. Sometimes, that manifests itself by, I call my guy and he never calls me back. I call the lady that I work with and she says, no, I don't want to do that for you. Or I don't want to talk about that. She might say, so what we do is we don't want to sell something. We want to build a plan and then walk with you through retirement. So if you're just looking for the latest shiny object that's making a lot of money, we really don't major in that. If you're looking for us to build you a plan and charge you the going rate of $7,900 or $8,900 and build you your retirement plan and let you do it yourself, we're really not into that. So therefore, if somebody, to your question, Kristin, is doing a great job with your money, we don't want to change it because we might not do as well. Okay. If we changed it, if we played around with it, if we made a change just for making a change, we might not do as well. We want to work with people that build a plan now and then to walk through retirement with them. And that's who we're wanting to call in. That's who we need you to call in.
And really, you have nothing to lose because either you're going to receive that second opinion, and as Tom shared, if you're on track, he's going to encourage you to keep doing what you're doing. But if there are areas that can be improved, if there are areas where you can refinance your retirement, if you will, then you'll know and you'll be able to have the right steps of action to take. So again, that number to call is 888-930-5609. Stay with us. When we come back, we're going to be answering some listener questions. Don't miss it.
More Right on the Money with Tom Mosley right after this. Get your own no-cost retirement plan review at 888-930-5609. That's 888-930-5609.
Are you worried about taxes eating into your retirement savings? By engaging in savvy tax planning, you might be able to create greater tax efficiency in your retirement plan. At Mosley Wealth Management, our team of retirement planning specialists can help you explore tax-deferred and tax-free investment options, as well as strategies to help potentially minimize your tax burden in retirement. Call Tom Mosley of Right on the Money and Mosley Wealth Management today to learn more about our tax planning solutions. Call 888-930-5609. That's 888-930-5609. Welcome back to Right on the Money with Tom Mosley. I'm your host, Kristin Oakley, and today we've been talking about refinancing your retirement. And Tom, I really appreciate, in our last segment, we were talking about the value of getting a second opinion. And you shared how if someone comes in and they're on track And if it ain't broke, don't fix it. You're just going to encourage them to keep doing what they're doing. So there's really no harm in getting that. If nothing else, someone can get the peace of mind of knowing that they're on track and can stay the course. But you shared a really powerful example with me off air that I would love for you to share with our listeners about a gentleman who recently came in. So do you mind sharing that story?
Not at all. About 3 months ago in our Glendale office, I met with a gentleman who, as I recall, had almost $3.2 million. And he brought in all of his information, all of his statements. We had a great conversation and a vision as to where he wanted to go and what he was trying to do. And he was a self-investor. And, I looked at his stuff and I made him the offer that we could do an analysis of it to see what kind of risk he was taking. And he came back in for a second appointment. That's complimentary as well. We never charge for any of our appointments because we're trying to find out if you want to work with us or we want to work with you.
Right.
It's a two-way street.
Fit, right? Both ways.
It's got to be a fit if it's going to be a long-term relationship, right, Kristin? And when he came back in, I did this guy's analysis, and he was taking about 80% of the risk of the market, which was right in line with what he was comfortable with by his risk tolerance score that we did for him. And he was making about 142% of what the market was making. So there again, that's the saying, if it ain't broke, don't fix it. I talked to this guy and I said, I don't want to change anything you're doing because you're doing well. He was a few years away from retirement. And I told him, I said, the only caution I would have would be you don't have anything of any of your money, 100% of it is at risk. Nothing is in the principal protected. I'm not going to lose that bucket. Okay. And, we shook hands and left. And about a week later, he called me and he said, there's two reasons I want to work with you. And I was shocked. And he said, I'd like to put about $500,000 into that principal protected bucket because I realize that as I'm getting older, I need to start hedging my bets a little bit and bringing some money over into that. And he said, secondly, I know everything about what I'm doing, but my wife knows nothing. And he said, if I'm in my late 50s, but he said, I hear of other people who are in their late 50s who pass away, and I just need my wife to have a relationship with somebody that I trust. And he said, you were honest with me. You didn't try to take it all and tell me I was doing a terrible job. You told me I was doing a great job. Take off, enjoy it. You gave me some options to consider. I've considered them. I want to put $500,000 in a principal protected bucket that you talked about. And I want my wife to come in and get to know you just in case anything ever happens to me. I want you to take what we're doing and I want you to take care of my wife financially. So, that might be your situation as well. You may be doing great. You just need to know the numbers behind you're doing great, and you need to have somebody that's there in case you're not there to do great anymore.
Exactly. That's such a beautiful, powerful story, and it just makes me smile because that's why we do what we do, right? I mean, it's helping people, it's serving people, and it's helping make sure that everything can be the best it can possibly be. And I just love that. Well, it's time for us to answer some listener questions. Each week, Tom and I try to get to as many as we can. If you have a question, you're listening, and you would like to email your question in, we always change the name, so you don't need to worry about your name being on the air. But that email address is info@mosleywealthmanagement.com. info@mosleywealthmanagement.com. So our first question this week, we have Justin in Glendale. He wrote in and said, I heard that lithium for making batteries is likely to be a huge growth area in the future as we move to more electric cars. How can I invest directly in lithium?
Okay. If you have any investments in companies that are out there, Justin, I will say this. You're probably already in lithium. All right. You probably are already well diversified and invested in lithium. Here's what I mean. To be invested in a new technology, you don't have to invest directly in that technology. Within your 401k, if you have the S&P 500 as an option, or a growth stock as an option, or a growth mutual fund, or a growth exchange traded fund, they're looking for growth areas. They're looking for areas that are coming on, that are in the future. They're going to be expanding. Lithium is one of those. Guess what, Justin? It's not news, okay? We've known about it for years, and it's already built into number one, what growth companies are looking for. They're probably already invested in those. Your mutual funds, your exchange-traded funds, those things that you're already invested in are probably invested in lithium. We get this question a lot of time, Kristin, about gold.
Mm-hmm.
And I run, after 29 years of doing this, I run my own portfolios: conservative, balanced, moderate, growth, and aggressive. And then we run them for taxable accounts and for pre-tax accounts. So we have different kinds of portfolios for different things. Guess what? Gold's in every single one of them, but it's in moderation. It's in 2% gold in everything except the super aggressive stuff that we've got. So you're probably, if you're looking at a well-diversified portfolio, Justin, you don't have to just jump in lithium all by itself. Oh, you could find the Holy Grail somewhere, and you could find the Ark of the Covenant somewhere, to follow through with that. But you're probably okay just to invest in good, solid companies that are growth oriented. They're probably already in lithium in some way.
Awesome. Well, moving on, we have a question from Madison from Vista. And this is really interesting, Tom, because we just finished up a series that we did a huge deep dive into taxes and lots of things that folks need to think about regarding their taxes. So Madison asks, what are some ways to minimize my tax liability? My husband and I have over $800,000 saved for retirement, but it is all in 401ks and traditional IRAs. We are both 60 and we plan to retire within the next 5 years. So what would you say to Madison?
I would say you are in the prime time to take care of minimizing your tax liability. In those 401ks and in the IRAs, those traditional IRAs already, you can begin to do Roth conversions. And that is, go ahead, particularly in 2024 and 2025, and pay the tax and convert that traditional IRA into a Roth IRA. With your 401k, you're still working for 5 more years, you said in the text you sent in. If you're still working for 5 more years, but you're over 59 and a half, you may be out there and you might think, I can't touch my 401k until I retire. If you're 59 and a half, there's probably a 92% chance, that's a real stat, okay, a 92% chance you can do what's called an in-service distribution and begin to convert that money that's never been taxed and is still going to have to be taxed in the future at a higher tax rate, the way the laws are right now. You can convert that money now, pay the tax now, and convert it over as much as you can stomach, into a Roth IRA. So now is the time to react, but you need to do it sooner rather than later. In 2026, the rates go back up from the tax cuts that we had in 2017. They go back up 2, 3, or 4% in every single bracket. React now. Madison, you need to call us and get on our schedule.
It's interesting, Tom. I'm thinking about this in the context of what we've been talking about today, refinancing your retirement. We've talked mostly about how it's important to move money out of risk and, looked at the benefits of guaranteed income, especially in this higher interest rate environment. Roth conversions are another way to refi your retirement, right?
Well, let's look at it like you were a company, because you are. Okay. And let's call yourself, your person out there, you are a company, you're a business. Now you're going to do a balance sheet. You're going to do an income sheet. You're going to look at your profit and loss, and you're going to look at your assets and your liabilities. Now you, in most cases, are sitting out there looking at $800,000 as an asset you have. That is an asset you have. That's your money. that's in those 401ks and those IRAs, traditional IRAs is what we're talking about here. But you're sitting out there and you say, I don't have 800. Okay, whatever you have, you're looking at that as an asset you own. But I also want you to understand that if you're really doing a balance sheet, you've got a liability on that asset. That all that $800,000 is not yours. You owe tax on that, tax to the government. That is a tax you cannot get away with. That is a tax you cannot overcome. You are going to have to pay it at some time. And we also know right now that that liability on that asset is going up in 2026. Now look at it that way. Now would be the time more than any other time in our lifetime. Tax rates are at their third lowest rate in history right now, and they're going back up in 2026. Now is the time to eliminate some of that liability against your asset of your 401k and your traditional IRA. If you understand this, you're going to be jumping at it. If you don't understand it, you need to call in and let one of our 6 all-star advisors sit down with you. It's one of the biggest things we do. We help people make sure they never run out of income the rest of their life, and they pay as little as they're legally required to pay in taxes. And you need to make sure and minimize those taxes. You are not required to pay any more tax than you're legally required to pay. But you need to call in, say, I want a blueprint. I want to help. I want to meet with somebody to build a retirement blueprint. And right in the middle of that, we will delve deeply into your tax situation, what you owe in the future.
There's never been a time for you to find out how you can refinance your retirement for the better. But we encourage you, the only way you're going to find out is by picking up the phone and calling 888-930-5609 to schedule a time to meet with the team of Mosley Wealth Management to see how they can help and serve you. Hey, thanks so much for joining us this weekend. We appreciate you being here. Be safe, be happy, be blessed, and we look forward to being back with you next time here at Right on the Money with Tom Mosley.
Investment advisory services offered by duly registered individuals through Mosley Wealth Management Incorporated. Mosley Wealth Management and Mosley Insurance and Financial Services are affiliated companies by common ownership license number 𝗿𝗶𝗴𝗵𝗵. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refers to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength, claims paying ability of the issuing carrier. This content is intended for informational and educational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the needs of an individual situation. All hypothetical examples are provided for illustrative purposes only. They do not represent real-life scenarios. Mosley Insurance and Financial Services, nor its agents or representatives, may give tax or legal advice. Individuals should consult with a qualified professional for guidance before making any investment decisions. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Some of the information provided may be from one or more third parties, which we believe to be reliable sources, but accuracy and completeness cannot be guaranteed by Mosley Insurance and Financial Services.